conference call indicated that for its subsidiary Balaji Specialty Chemicals, there was an expectation of a subsidiary where the company is actually making a capex of 750 crore rupees on this subsidiary. A lot of products that will be manufactured there. That list will come up for you on the screen. But remember, out of that 750 crore rupees, 1/3 of the money will be given by the state itself. So that definitely is a positive for the company. Other than that, they do have a lot of projects which will be commissioned. Out of this, EDTA 2NA, some of these projects, Unit 1 will get commissioned in September 2026 and the second part will get commissioned in December 2026. Additionally, the company mentioned that once all these projects come on stream, they will see an improvement in operational performance, and that is something that the street is watching out for. Most of these projects are funded internally. The DME plant will come in FY26. We have the other plant which will come in FY27. So internal accrual, so they are not taking any debt. Additionally, they have the subsidy grant which is coming by, and the management expects improvement in performance once these projects are commissioned. So good things, good commentary coming in for the company, and that's why this big surge on the stock price today.
Well, what a move on a day when market is seeing so much pressure. Well, a couple of stocks from the telecom space, Idea as well as Industar, showing a few specks of green in an otherwise very, very weak market. Both of these stocks doing quite well in the session. Idea up over 1% in the session. But we'll now slip into a short break. Up next, we will focus on the electronic manufacturing space stocks as JP Morgan expects a soft Q3. Stay tuned. Welcome back to Midcap Radar. Well, one set of stocks that did very well yesterday was the midcap IT space, especially JP Morgan had come out with a note where they said that the top pick is KPIT Tech, and the stock moved quite significantly yesterday. Today, most of the names are seeing quite a bit of selling pressure. As you can see, Persistent Systems has cooled off, KPIT Tech now near the day's lowest point. Other names like Coforge and a whole host of IT stocks today under significant pressure, especially TCS seeing quite a bit of pressure. The other stock that's cooled off significantly from the day's high is Paytm. That stock now down almost 1.7% in the session. The other set of stocks that we've been discussing at length has been the electronic manufacturing stocks. When you're talking about names like Keynes, Dixon, Amber Enterprises, they've been in focus of late due to multiple factors. JP Morgan has written a note on these companies with their expectations for how Q3 panned out for these names. Upasna joins in with more details.
Well, certainly EMS players certainly were the talk of the town in third quarter because of various reasons. Now JP Morgan is expecting overall a soft quarter this time around for most of the players. It expects Syrma to grow the fastest in third quarter, followed by Keynes and Avalon Tech, while Dixon and Sign DLM are likely to lag. Now coming to Dixon first, the brokerage expects that the mobile volume guidance for FY26 and FY27 could be cut down due to delay in its Vivo JV approval. Keynes, it expects the revenue guidance to be cut down to 4,000 crore from 4,400 crore, while it expects the company to maintain its EBITDA margin guidance at 16%. Syrma, it expects the company to maintain its revenue growth guidance of 30% and even the EBITDA margin guidance of 9% plus. Coming to Amber now, it expects the consumer durable revenue growth guidance to be brought down from 13 to 15% to 10%, while the electronics revenue growth is likely to be maintained at 32 billion. Now let us look at the key ratings and target price given by the brokerage. On Dixon, it has given an overweight rating with a target price of 13,700 per share. Amber neutral with a target price of 7,400 per share. Keynes overweight rating with a target price of 6,100 per share. Syrma overweight rating with a target price of 1,000 per share. And lastly, Avalon Tech with an underweight rating and a target price of 800 per share. So overall, a subdued quarter is what is expected.
Well, a subdued quarter, and all eyes will be on whether managements can go ahead and maintain the guidance for Q3 and FY26. With the news that the Nifty has for now managed to defend the 25,900 mark, we take your leave on this edition of Midcap Radar. MF Corner when we return.
Hello, good afternoon. You've tuned into MF Corner on CNBC-TV18. I'm Vinny Motiwala. With me is my colleague Sonal Putra as well. Sonal, a very good afternoon to you. But viewers, today what we're going to be talking about is actually we're discussing all your stock-related queries.
Mutual fund-related queries.
Yes. Oh, mutual fund. So used to stock, but mutual fund-related queries. All your portfolio queries that you all have sent us, where you all could look to invest. And to do that, we just have with us our experts for today, Abhishek Kumar, the SEBI RIA and founder at Sahaj Money, as well as Kshitij Mahajan, co-founder, Complete Circle Consultants, joining in with us to answer all those queries as well. Good afternoon, gentlemen. Thank you so much for joining us on the show. Let's start with the first query for today. We have Dhyan Shah, who's writing to us from Mumbai. Now, he says that he has just started earning and getting around 45,000 rupees per month, says that his life and medical insurance is covered by family, and asks how he should start allocating this money within the asset class. Abhishek, let me start with you for now.
Sure. Thanks for having me, Vinny and Sonal, and Happy New Year to you and your viewers. To Gideon, I would like to state that I'm a SEBI RIA, so I would not be able to give personalized advice in this session, but I would talk in the kind of framework I use to evaluate investment decision with you. So Dean, to begin with, it's a great question to ask about asset allocation. The framework I use depends on essentially three things, which is the time horizon that you have, which is nothing but how long you have until you need this money for. Second comes risk capacity. What is your capacity to take the loss or that you can afford to take? And finally, your risk appetite. That is what is the kind of volatility that you can withstand and still sleep it through. With this, the typical allocation for different category of investors with say risk appetite in conservative category could be around 20 to 30% in stocks, 60 to 70% in bonds, and then 10% or so in alternative assets like gold and such. Whereas it comes to moderate risk appetite, we suggest an asset allocation of around 40 to 50% in say equity, 40 to 50% in bonds, and then again 10% in alternative asset like golds. And finally, if you have a very aggressive risk appetite, then a asset allocation mix of around 60 to 75% in equity, 20 to 30% in bonds, and again 5 to 10% in alternative asset would be an apt risk appetite. So which risk appetite or asset allocation suits you would require a detailed risk profiling, but I believe you would get a kind of an idea how you should go about it.
Okay, all right. Take that point, and congratulations to Divyan as well. Very good to talk about investing at the start of your job as well. So let's get this conversation and this question with Kshitij as well. Kshitij, do you agree? Of course, it's very different for different people in terms of the risk profile, but an average allocation, how should he go about it?
Yeah, so hi and Happy New Year to you and your viewers. So yeah, I think it depends on individual to individual. Being young, he can have a little bit more on small and mid cap side. Normally I say follow 50-30-20. 50 should be large cap, 30 should be mid cap, 20 should be small cap, but it should be not at the fund level, but at portfolio level. Because in multi cap or larger mid cap also you have some small and mid cap exposure. But yes, I think valuation wise, we all know last 1.5 years has been a tough year for us. And we have smaller mid cap also, almost bottoming out. So I think this is the time when he can start stepping up. My request is, if he can spare a little more, like he's earning 45, if he can spare a little more, he can stretch a little more, then he can see that magic number 1 crore coming soon his way, because the rule of 15 follows. If he can't do now, otherwise he can keep on stepping up every year as and when he's getting his salary increment. Rule of 15 says if you have 15,000 going in as a set, 15% will compound that, and you do it for 15 years, you'll have 1 crore on your way. So, but yes, if he can't do it now, at least 20% plus should go, come what may, for all the viewers who are listening to us, should go and set as a discipline rule. Because right now, what is important is for us, because the medical says we're going to live long and we need to beat inflation and have that type of stability going our way. So I think fund-wise, yes, it's a good combination of a multi-cap, larger mid-cap, flexi-cap, focus, and smaller mid-cap should be done.
Okay, point taken there. Obviously, start with SIPs, 20% at least should be something that should be going there. Thanks for that, Shatij. Next query for today, we have Nishant Bhatia, who's writing to us from Chandigarh. He's asking about how many mutual funds should one have in their portfolio. And considering he's given his goals also, like a good retirement corpus you want lump sum for vacation as well, education, kids education, that's a goal as well. So how should one go about it, and how many mutual funds are enough for this situation? Abhishek, what is your thought on this? Because sometimes you add so many mutual funds or you have so many different categories which may not even make sense according to the goals. What should Nishant be doing?
So first of all, Nishant has a right ideas about goal-based investing. That's a way to think about it. And in terms of the second part of the question about how many funds to have, there are no exact answer to begin with. But I'm also thinking on the similar line that you spoke about, that having too many funds lead to two problems. One is a lot of overlap between each funds, and it adds to the complexity that you create in the portfolio. So if you follow modern portfolio theory, right, there is a point where you, let's say, have assets or let's say stocks in your portfolio which are lowly correlated to each other. So that way, there is a point where you add more stocks that leads to diversification and reduction of the portfolio risk. But beyond a point, it doesn't help. So it leads to probably adding up the same thing over and over, and the overall portfolio volatility does not reduce. So to that extent, the same kind of principle you can apply with mutual funds as well, although mutual funds are different investment vehicle in that sense. But a mix of around 5 to 8% should be good enough instead of having 20, 30 different funds in your portfolio. With that intent, a goal-based framework where you invest in for retirement goal, say for 20 plus years in equity-heavy portfolio would be an apt allocation. Whereas compared to that, if you have kids and their education in next 10, 15 odd years, then a balanced portfolio with around 50-70% allocation into equity would be apt. And finally, for short-term goals and such, where you might require money at a very short notice, a debt-focused allocation, even to the extent of 100%, would be the kind of portfolio that we would suggest with. And in that asset mix, different mutual fund portfolio mix of, say, multi-asset funds with a mix of stock, bonds, plus alternative asset like golds would also be there. An alternative way of doing it is through flexi-cap funds, where it is equity heavy allocation across market caps. And then finally through balanced fund as well, where you have a fixed equity and a debt allocation mix. These kind of allocation would be apt for Nishant in this case, Sonal.
Take that point on what goal-based investing would mean like, and we do have solution-oriented funds as well, right? So do you think, Kshitij, that is the way a portfolio should be formed?
Well, I feel that this entire journey should be seen as from one point to another point, which is like you started working and getting retired in a good way, where you have a good corpus with you. So journey is equally important as the destination. Do you have various stations in between where you have all these goals in line, whether it's your kids' education, marriage, your retirement, buying a house, buying a car, luxury vacation, whatever it is. And if you have a SIP aligned to a goal, then come what way, markets going up or down, you not stop that SIP unless until you not achieve that goal. So I think, yes, alignment is very important, because then there is a purpose of that investment. Otherwise, we'll keep on thinking about, oh, this will become 2 times, 3 times, 4 times, can I move out? And if you see, there are more than 12 mutual funds which are given more than 100 times return, whose NAV is more than 1,000. So I think alignment is very important along with your goals. And I think one should have a short-term goal also. Anything which is more than 5 year plus, one should allocate only large capish plus equity-oriented funds. Less than 5 years to 3 years, one can look at a multi-asset or balanced fund approach. Less than 3 years, it's fixed income, which is a corporate bond fund or a short-term fund can be looked at to do that. Along with that, when you establish your goal, before doing that, you should actually look at building an emergency fund for yourself home, because all these investments are a part of your salaries coming in and you're participating to SIP route. But in some case, like we have seen COVID times, so you should always have some emergency fund which can be between 9 months to a year amount of your salary, which should be parked in arbitrage or a short-term fund which can be used as and when if you require that fund.
Point taken there. Let's move on then to the next query. Nitin K is writing to us from New Delhi. He says that he's investing in all direct mutual funds such as Parag Parikh flexi-cap fund, Canara Robeco, large cap fund, Quant mid-cap fund, and he's asking if he should make any changes in his portfolio. Your thoughts on this one, Abhishek?
Yeah, so Nitin, good to have all these mutual fund in your portfolio in a direct, let's say, manner, so that you're saving a lot of expense ratio and that saving is coming your way. But when it comes to evaluating all this mutual fund, we look at multiple lens. The first lens that we use is to check whether there is overlap between funds. So when you compare Parag Parikh with that of Canara Robeco large cap fund, look for kind of duplicate holdings or large cap holding between each of them. That would also help you realize or consolidate your portfolio, whether it makes sense to continue investing in these two funds, or perhaps you can consolidate in one of them. The second point of view is also about concentration risk per se, whether 3 to 5% of 3 to 5 funds in mid cap and small cap leads to a lot of equity heavy exposure. So if you don't have say debt allocation, so perhaps that also could be looked at instead of just focusing on equity led portfolio. Then comes the performance lens, right? How each fund has performed compared to the benchmark or their peer in terms of rolling returns over multiple period is would be a good lens to review in terms of making consolidation decision. And finally, expense ratios. So you are already in direct plan, so you made the good choice for yourself. The question to ask would be to whether that matches your risk profile or not, and whether there are underperforming funds in this portfolio. So use these frameworks to arrive at that decision and then consolidate, I would advise.
Okay, all right, take that point. Gentlemen, we have a lot more queries for you, but we have to slip into a quick commercial break. When we come back, we'll get going with the other names and other queries as well. Stay tuned for that conversation. Welcome back. You're still tuned into MF Corner. We still have with us Abhishek Kumar, SEBI registered investment advisor and founder at Sahaj Money, and Kshitij Mahajan, co-founder, Complete Circle Consultants. They are here to answer all your MF queries. Kshitij, let me start with you for this time. Jyoti Raj is writing to us from Mumbai. Says he has invested around 41 lakh rupees in mutual funds, stocks and NPS Tier 1, which is a primary retirement savings account. He has an SIP of 30,000 rupees every month, which he says is expected to increase by 5,000 rupees every year, and wants to earn a corpus of 5 to 6 crore rupees by the time he's 55. He asks what else he needs to do to reach this goal. Very specific targets, very specific SIPs and allocation as well, and very clear about what do they want when he reaches that age mark as well. Kshitij, do you think he needs to add something else to this mix? Of course, we will get the details of his portfolio as well. Do you think it's apt for the kind of goals that he has?
Well, I believe, let's imagine, because we're not clear about the age, but let's say if he's around 40 and we have 15 years of journey on our side, so the type of amount which he has right now, which is 41 lakh, if it will grow at 12%, this will be around 2.2 CR. Let's say if it will grow at 15%, this will be around 3.25 CR. Second, let's imagine, let's assume that the SIP which he is doing of 30,000, 5,000 step up every year, if it will grow at 12%, again it's close to about 2.3, 2.4 CR. But it will grow at 15%, again 3.3 CR. So if the journey is for 15 years and the estimate is that 12% is the growth which is going to get in this fund, which is a right expectation as on time, as we say, because nominal GDP is around 10 now. So it will be around 4.7 to 4.8 CR. That's how. And if the portfolio will grow at 15, then it will be around 6.5 CR. So I think let's assume 12%. Then he need to add some more SIPs to his portfolio, or maybe as and when, if he can't afford right now to add more, as and when he will have some step up going on his increments. Because right now we talk about 5,000 increment, which is around 18% of the current SIP portfolio. But eventually the size will become big, his salary will become better. So he can add much more to his SIP portfolio so that he can, with some little effort, he can escalate to the number which he is looking at it. At the same time, don't go for a lot of allocation towards small and mid cap. With flexi and multi-cap fund also, you get allocation in small and mid cap basket. Sometimes just chasing that 1-2% extra return, we go overboard and take that risk. I think there is no need for that. Just follow rule 50-30-20 on portfolio level. 50 should be large cap, 30 should be mid cap, 20 should be small cap.
Okay, a good rule to follow there. Thanks so much for that, Kshitij. But let's move on to the next query. We have Pratik, who's writing to us from Pune. He's asking if it's a good time to invest in multi-cap assets or flexi-cap funds, and which is better investment strategy of the two right now. Abhishek, your thoughts?
So Pratik is doing right thing and is thinking on right, let's say, frame of mind. So in terms of multi-asset funds, as you understand, it's a portfolio mix of both equity, bonds, and gold. So there is a built-in diversification embedded in that, which you go with portfolio theory is that it leads to lower volatility because there are assets which are lowly or have low correlation with each other. So that kind of reduces the overall portfolio volatility. So that's, if that is something he is looking for, so that is the right way to look at that. But whereas flexi-cap, because it is 100% equity across market caps, so that leads to higher growth potential, but it also comes with higher volatility because there is a single asset class mix in that portfolio. So with that intent, he should evaluate what is his requirement. If he's looking for lower risk in 5 to 10 year horizon, then he can look at multi-asset kind of fund. Whereas if he's looking or willing to take higher risk for a 10 plus year horizon, then flexi-cap would be a good mix to have. So smart approach would be to use both and then see how it plays out over a period of time. So if that is something he's looking at, I would suggest having a multi-asset fund as part of his overall core portfolio to around say 40 or 50%, and then a satellite portfolio with a 20-30% allocation mix in flexi-cap. So that would meet both his needs if he's looking for a hybrid approach.
Okay, all right, take that point. Let's go across to the next query, which is coming in from Kunj. He's a 36-year-old businessman and wants to invest a sum of 50 lakhs in an income plus arbitrage fund for retirement. Which one would you suggest? The time horizon is of around 10 years. Kshitij, comment on this?
So I think the reported number inflation looks zero, but you are to put inflation at 6%. Education inflation is at 10 to 12%. We are at 36 years of age. My request is that these type of investment will not be able to beat your education and food inflation returns. So I think by rule of 72, if you grow at 6% also, your money will be doubled in 12 years time. And obviously, it will attract whatever tax part is there. So post tax, maybe it will take a little long. So if you want to play safe also, then I think right now you can actually add a combination of a multi-asset, a balanced advantage fund, and on a safer side, 10 to 15% allocation, take some risk on next Nifty next one. I think if a combination of these three, along with some allocation towards arbitrage, can be worked out, then you can look at actually targeting 19% type of yield on your portfolio, which is much better than what you are looking at when you're parking arbitrage and your income fund. Please understand the value of money is depleting. The same formula which is for commodity is for inflation also. If your inflation overall, let's say, count at in education, food, everything you count, average is 6%, then value money becoming half in 12 years' time. So when you are investing into asset class which is pre-tax and there is a tax after that, then you're not even beating the inflation part. So please, you need to get little extra from your investment for that. I think this is the right way to approach your investment.
Okay, thanks for that, Kshitij. Let's move on then to the next query. We have Nagesh who's writing to us and he's saying that he invests 33% of his savings in mutual funds and NPS. His goal is retirement, his daughter's education as well as marriage. Now he has a two-part question. First, he's recently switched from SIP, his SIP from ICICI Prudential US Blue Chip Equity Fund to ICICI Prudential Thematic Advantage Fund of Fund because he gets the global exposure. He's already holding a Parag Parikh flexi-cap fund as well. Now he wants to know if that was a good choice that he made. And the second one is he wants to know if he should replace the 3 mid and small cap funds that he has with a multi-factor fund like a Mirai Asset multi-factor fund. Abhishek, your view?
Sure. So two parts to it, as you rightly said. So he has made switch one, wherein he switched from a US blue chip fund to a thematic advantage fund. So the logic is solid, where he is already getting exposure through Parag Parikh flexi-cap fund. But I would suggest that instead of thematic fund, when he is taking exposure for let's say US equities, perhaps he can look at something like a tech or innovation focus fund, because which is different than the geographic diversification which he is already achieving through Parag Parikh fund. So in that sense, a total international allocation to say 20-25%, which would be having through Parag Parikh fund, he can increase that mix through a tech innovation based kind of focus fund. So that's the answer to the first part of the question. Coming to the second part, where he's trying to consolidate his portfolio from 3 stated funds to a multi-factor fund of fund. That the current mix is a mix of Nippon Small Cap, which is an active fund, thematic fund, which has a concentration kind of such composition, and the final bit is Midcap 150 index fund. So shifting to a multi-factor fund, which has a mix of both value plus momentum, quality and low volatility, that would have pros. I mean, in terms of fewer funds and lower cost, but he would lose on the active fund, let's say, performance that he could achieve in the current exit mix. So he can take the call based on what is more important for him at this stage. If he wants to consolidate its portfolio and have lower cost, then a multi-factor fund of fund could be a better switch.
Okay, all right. Take that point. Thank you so much, gentlemen, for joining us today. We have actually gotten a lot more queries. We're out of time, but I'm sure we'll plan that for some other day. Thank you so much, Abhishek and Kshitij, for your time today. And with that, we'll take your leave on this edition of MF Corner. But stay tuned for Closing Bell to take you through the last hour of trade.
It's a mixed picture, similar to what Wall Street was last night as well.
Step one is the stabilization of the country. We don't want it descending into chaos.
Market sold off into close. Nasdaq was also up a little bit more. That also sold off. But, I mean, of course, there was a bit of a positive close. This is a start. 26,100 on the Nifty, 84,700 something on the Sensex. So it's a pretty quiet start.
The domestics are hoping we have a better year than last year.
The GDP for the full year is estimated by the MOSPI at 7.4%, obviously much better than last year's 6.5%.
We saw in 2025 and exactly how 2026 began as well. Overnight finally has started with some profit taking.
Completed the enrollment of study participants in their phase 3 clinical trials for their dengue vaccine.
It is on the back of a subsidy that the company has received. It's a certification.
Overall, I believe this will drive category growth, and our role has been category maker.
Another day where we're seeing severe selling pressure which has come by.
If you look at IDFC First Bank, they have cut down their savings account rates almost by 25 to 200 basis points.
Big updates coming in from the US, and that's the reason why we are seeing that impact on Indian markets as well.
Well, that is the day so far. It is down and out once again here on the markets. 200 points lower. The Nifty below the 26,000 level, and of course it's broken below the 20-day moving average as well. It's been coming for a while, and I think it's finally happened. It's a short-term, important, pivotal level that many do use, especially those who are trading. This is Closing Bell. We are coming to you live from the CNBC-TV18 News studios. I am Prashant. Nigel and Reema with me. Guys, afternoon.
Hi, for the last 3 days, we were down, but we were never out.
Yeah.
But today when you look at the Midcap screen, it's a near 2% fall on the Midcap index. Look at the advanced decline ratio, 2,500 stocks in the red for less than 500 stocks gaining. And now the screen is looking a tad bit ugly.
Yeah, I think that passage of that bill and the fear of higher tariffs with regard to crude oil that's coming out of Russia, that's clearly dented sentiment, because from the time that news hit the wires, that's when, in fact, we did see a deeper gash. And the evidence, with regard to expectations on the trade deal has been Gokul Das. That's down more than 10% today, clearly telling you the street is getting a little bit skittish with regard to when that India-US trade deal will come about. And, in terms of the timing, in terms of what kind of leniency we can get from around this 50% odd mark. So that clearly is the barometer out there. When there are hopes, we see Gokul Das up and about. It's corrected big time from the top.
It's an interesting thought experiment. Say tomorrow evening we get, but it'll be Saturday morning for us, right? I mean, their morning, Friday.
You're talking about the opinion day, the judgment by the Supreme Court.
The judgment from the Supreme Court will be Saturday.
We'll get it on, we'll react to it, I think, on Monday.
On Monday.
Yeah.
In any ways, we will react to it on Monday. But I think the judgment itself for us will be Friday morning, which will be...
No, it's Friday evening US time. What time is it on Friday in the US?
We'll check it.
We'll check it out, but I think it's... either way...
I think I've confused myself. But the point is...
Friday during the day is when they will take it on board, right? Yeah. By that time, we'll be done.
No, that is clear. We will only be able to react to it on
Monday.
On Monday. So that's for practical purposes. That is my point was. Say for example, the Supreme Court strikes it down. Immediately, President Trump will come and post that the judges are this and bad and all of that stuff, and he'll say, "Well, I'll find a way to reimpose it."
Yes.
When we come back on Monday, the question is, will Gokul Das be up down 10%? Will it be? What will it do on Monday? I mean,
according to Google, it's 10 a.m. Eastern time. So we will get the announcement late on Friday night.
We will get Friday night. Yeah.
Friday night. It's 10 a.m. Eastern time.
So to the other question, which is what will
Gokul Das, I think it's already at that 52-week low. The 52-week low is 590 rupees. It's at around 610 rupees.
Yeah.
So is the tariff going up further from here? I mean, I don't know. Otherwise,
I think it'll even if the judgment will come and President Trump being President Trump, he will rant and rave about it and say, well, etc. all of that, and he'll communicate adequately that the tariffs are going to stay one way or the other. But I think for a period of time there will be some amount of confusion, because the other routes, etc., are more cumbersome. There will be a gap between because these tariffs are done under emergency route, which is what is being challenged. Now, if he's got to do it through the proper legislative route, that will take time.
Yeah.
So, and of course, there is the question of now that the Supreme Court has voided these tariffs, if it comes to that.
Yeah.
I mean, there is the question of refunds, etc., right? So, I think a few days at least, there will be some amount of chaos, right? Generally, which is not such a bad thing for a a market like India, especially names like Google does, which is basically it's half from the highs, the recent highs. 1,200 or so was the high, at about 600 now.
What a tricky time, right, to interpret news. You have suddenly Trump deciding once you get into a country, pick up the leader from there, take him back and try him in some court. Then you're waiting by in terms of tariffs. Which one is more deadly?
But I think the Supreme Court one is important because apart from the economic impact of refunds, etc., tariffs, a verdict against him will also sort of rein in his executive powers. But if the Supreme Court in a way sides with Trump, it just gives him more powers to unilaterally push through his agenda as he has been, but with a lot more vigor. So it's going to have consequences.
No, I think there's one more thing last night which has been not talked about that much, right? The so-called ICE agency, which is which are responsible for all these deportations and etc. There was an incident where they shot and killed a man in the US. Okay. I'm 100% sure that's a US citizen, by the way, an American. By whatever, and I think it's going to play out in the political news cycle in a big way as well, right? So it's not going to go down with the electorate. Yeah. So to the point of political approval for everything that he's doing, stuff like what happened last night. Yeah. I mean, I think it's that is the other thing. So yeah, I mean, I was thinking, and India was briefly referred to as the anti-AI trade. Is India the anti-Trump trade? I don't know. I don't go that far.
Yeah.
But India, of course, certainly is one of the worst affected. So, the point is with that 500% number is scaring people. Philosophically, tariffs are at 50%. So it can go higher, but then beyond a point, it becomes all the same. It's already hurting exports a lot. I think that's an important point because I think many people are looking at exports out of India and saying, well, the hit is not that much. The important point is a lot of that fall is buffered by exports of Apple products out of the country. So that is the reason why the overall decline in terms of exports to US doesn't show up that much. So we can chat more about this as we go on. Let's just quickly talk about what's coming up here. So it's broad-based, of course, 200 points lower, below the 20-day, and it's geopolitics through and through across the board. And we have a special guest joining us in just a bit. We have the former chairman, managing director of HPCL, Mr. Surana, who will talk to us about that because oil, of course, is the central point here. And we'll have him join us in just a bit or so. Some other stocks, metals, etc. There's a bit of a profit booking unwind. So the metal index is down about 3% or so. How should you position yourself is the question. Mitesh is with us with exactly that. Mitesh, what do you recommend?
Prashant, early in the day, we were talking about the fact that, we might test the lower end of the range, which is close to about 25,900. We've kind of gone there and just managed to hold on to that level. Not a sign of reversal is yet, so I'm waiting it out on the index. But yeah, in that sense, I think today's low is an important one, 25,884, 885. I think that entire zone of 25,900 to about 25,850 is a key level. If it breaks, then I think we might have more correction. So watching it closely. Right now, I have one buy and one sell. I have a buy on NTPC. I think that's a stock which gave a breakout, is giving a pullback, giving you fresh entry level, which are good. So buy with a stop at 340 for targets of 355. And NBCC is a sell with a stop at 115.10 for targets of 107.
Okay, all right. Let's. I think there is only one topic which is being debated, which is being talked about in markets right now, which is of course this that tweet last night from one of the US senators about the Russia sanctions bill, and that's the tweet I'm talking about. I'll put it very simply. So far, only two entities were sanctioned by the US, Rosneft and Lukoil. So you couldn't buy oil from there. But companies, etc., were buying what was non-sanctioned oil, basically, from other sources. Now the bill last night essentially says that anything you buy, any Russian oil you buy, basically will lead to up to a 500% tariffs on everything out of the country. Which is doing this, and it of course specifically names countries like China, India, Brazil, etc. And I think that is what is causing a fair bit of nervousness. We have, as I said, Mr. Surana joining us. He's former chairman. HPCL needs little by way of introduction. Mr. Surana, good afternoon. Our first chat in the new year, so wishing you a happy 26, sir. What I want to understand from you is this: what should And I can tell you, people are kind of puzzled how to look at this. How much are we buying how much Russian oil are we buying currently? How can we, is it sanctioned? It is not sanctioned. I'm assuming it is all non-sanctioned, whatever we're buying anyway, right? Which is not from these two entities. So just talk to us a little bit about your thinking on this matter.
Good afternoon, Prashant, and wish you a happy new year to you and all your viewers. So as far as the Russian oil is concerned, it has gone into different steps, the sanctions. So the last sanction is on particular entities and particular assets. The oil per se is not sanctioned and the country per se was not sanctioned. And therefore, India was importing Russian oil from the entities which are non-sanctioned. And to that extent, depending on the techno-economic analysis, the companies were making their buying decisions, depending on what suits to their refinery, depending on what the configuration they have. Now, the new tariff, the way of course, it is yet to be passed, and whatever we have seen it in the media. First thing, we need to be clear that this is not India specific per se. So what it says is that the president is empowered to increase the tariff to 500%, at least 500%. That's the way it mentions, for relative to value of all such goods and services which are imported from the countries which have an exchange of petroleum products and uranium from Russia. Engage in import of, knowingly engage, rather, that's the wording which is used. So there are a lot of wordings which we need to interpret properly and we need to see. Right now, when the tariff is being applied, there is a list of the products which are not included there. So there is an exemption list also. So we also need to see that what gets exempted and what doesn't get exempted for tariff. So whether it is 50 to 500 for all the goods or for the thing which are applicable to that's the one. And second, we also need to say that there was also earlier, there are some, as far as the Europe is concerned, that sanction had a value limit on the price of the oil. Whether ultimately the way it passed, whether that is also something related to tariff, which related to price of the crude, which ensures that the oil flows, but there is no substantial financial gains to Russia, what seemed to be the purpose. So we need to see it in this context, and provided it gets passed, because it is not only India specific, it also affects the other countries like China, Brazil, and there may be other imperatives which may have some repercussions, and therefore the implementation may be country to country, implementation may be depending on the goods, implementation may be dependent on the context in which it is done and when it is done. So right now it is more an empowerment and legal frame which is being provided to it.
Let me ask you this, right? If you were running HPCL and you ran HPCL for many years successfully, what would you do to this? And you see this out there, what would you do?
No, as far as any country for that matter, why HPCL or any company, they do the techno-economic analysis. So there will be a crude basket which can suit to the refineries which we have, and there is an objective function basically which is the net refining margin which it gives. And you run that model, and then you apply the constraints which is availability or any sanction, non-sanction, etc., and based on that which suits you best you do. So the discount comes into picture, the freight comes into picture, the availability comes into picture, and any other constraint.
No, that is how you would normally do it, Mr. Surana. But my point is, given this threat, right? How would you respond? I mean, at the end of the day, as you've said it many times, and as you're saying right now, also it's economics, right? I mean, the price that you're paying. Techno-economic. So, but in the face of this, and this is highly unusual, the situation we are faced with, would you look to a question is hypothetical. If you're running HPC, would you look to the ministry for direction? Like, how would it happen? What would happen?
So the question is that if there has to be a diplomatic or a geopolitical context, and if there is a government directive on that we need to follow. But if there is no government directive, then the companies will follow the techno-economic interest of that. That will be the logic and the pecking order.
Okay. Okay. So companies will not abandon the logic of in terms of where they buy oil from, which is what you describe as techno-economic, unless they're specifically asked to?
Naturally, because it will be wrong on the part of the companies to apply the logic which is not actually told them to be a constraint. So the companies are supposed to look into which is in the best interest of their stakeholders, and that is a techno-commercial analysis of the crude, which is the best buy for them and which gives the best margin to them. And if there is a constraint, then that is to be superimposed on it, and that constraint can be superimposed only if there is a specific direction to that effect.
Yeah. Typically, in a situation like this, would you imagine that there would be I don't know if there have been any instances when you were running HPCL where, there are circumstances, right? I mean, where the government, as the rightful owner, can step in one way or the other.
So when you are in a war, you find the situation and then find a solution according to that, and there is nothing right or wrong or absolute answers to that. So when the bill gets passed and then when it comes under implementation, at that time the situation is to be reviewed and the answer has to be found. So far, country has navigated these issues, and it is not the first time that we are facing a situation like this. Maybe it is the number is creating an awe to everybody, 500%. But the question is whether it is 50% or 500%. It is the economics will get disturbed. So the country and the companies have to take a call accordingly. So it is not a new situation. It may be a new context.
Yeah. Typically, just to understand, when you buy oil from Russia over the years, not just now in the last year and a half, how is this done? This is bought directly from companies like before these two entities were sanctioned. I mean, our companies buy it from? So which entities do they buy from? These companies directly or through traders, or how does it happen?
So historically, India has not been buying much of Russian oil because it was not finding the economic favor because of the freight cost, etc. Only after the discount started coming, that's only the Russian oil started finding favor. That's the first part. Now, because you have got a term contract and the crude contract, because India was not traditionally buying a lot of oil from Russia, there were very few term contracts. So it was basically spot which was going by tender, and the tenders were mostly on the delivered basis, because that is a rough terrain which has to follow, and therefore it was mostly on delivered basis, and so that is how it was being bought so far. Only when the quantity of Russian oil increased substantially, at that time only some companies thought of going for the term contract, but that also on certain terms and conditions.
Yeah. No. I get that. That is pretty useful to understand. Is it? I mean, in the next couple of days, right? If we see statements from, is it possible we see statements, individual releases from oil companies like HP, IOC, BP, etc., saying, I don't know what they'll say. Is it possible they kind of clearly put out we're not buying? As I understand it, the percentage of Russian oil is pretty low. Is it possible they come out and give us numbers or say, well, it is zero, like a private refiner has done recently?
No, I assume that the private refiner has reacted to certain news which was already there. So it was more, I think, a response to a news. Of course, it is for the companies to decide what they want to put out, but I don't think there is a need for the companies to suo motu put a statement to that effect, unless there is a trigger. So it is individual companies, the commercial interest which they need to protect in the larger context of the country's interest. And I don't think that there's a need for the companies to put a suo motu statement to that effect, that whether they are buying, they will buy, they will not buy. We need to see as it develops. So right now it is premature to say that.
Yeah. As the saying goes, right? Maybe we live in strange times, and this is certainly one of the strangest times we find ourselves.
One more thing we need to be clear is that you can't be sure that in today's environment, more things get implemented by the tweeters rather than something getting passed in the Senate or the House of Representatives. So a bill coming in the Senate or the House of Representatives for discussion, that does not automatically mean that something else cannot happen or something which is passed will happen. So
absolutely. And all valid points, Mr. Surana. I think we'll see how this goes, and we'll continue to track it. But I think this does add a fair bit of texture to the conversation from someone like you who's run.
Probably I can add that irrespective of whether we buy from Russia or not Russia, in today's situation, supply is not a problem at all because it is an oversupplied market.
100%.
So the question is, supply per se is not a problem. It may be pricing issue. It may be whether you're buying from X place or Y place. But the second point is, even if you are not buying from X place, in the oil is an international commodity. It finds some place, its way to some other place. Overall, it does have its input in the total supply situation, unless you completely block that supply source. So that point we need to keep in mind.
Yeah. No, 100%. Mr. Surana, thank you very much for joining us. It's a pleasure, sir. And we will invite you back because this is, of course, not the last word in the story. Perhaps there is more to come. And hopefully, fingers crossed, nothing worse. Well, I think we'll take a break. But before that, let's just turn back to the market. Hormuz is standing by with a spotlight on the top movers. Backed by volumes one way or the other, up and down. Hormuz, take it away.
Well, the one common trend that you're observing on the stocks that are falling today is, barring a few, most of the stocks that are declining 7, 8, 10% are not declining on very significant volumes. It'll give you some case in points as well. Now, look at these export-oriented names. Gokaldas, Avanti Feeds, Apex Frozen Foods, all down 7 to 9%. But take a look at the volumes here. Gokaldas Exports is, of course, trading on very significant volumes. The 33 lakh shares traded compared to a 2 lakh share daily 20-day average. Avanti Feeds, well, hardly 2x of its 20-day average, but Apex Frozen Foods is trading on volumes that are less than 50% of its 20-day average. So not significant volume seen on these export-oriented names. The other stock in the list today is Balaji Amines. That is one stock that has been bucking the trend today in an otherwise wobbly market. It snapped a 3-day losing streak today, the biggest single-day gain that the stock has seen since April of 2021. Today's volumes are already the highest on record. Close to 1 crore shares have been traded today. The 20-day average is only 34,000 shares. Now, the stock has moved above its 50 DMA, which is at 1187, which is the level at which it is currently trading at. The 100 DMA on the upside is at 1320, so still some distance away on the upside. There's been an underperformer around this time, around 40% below its 52-week high, which is close to 2,000 rupees. And it has entered this new year after 4 consecutive years of negative returns. Now, take a look at the PSU names as well. This is another case in point of stocks not falling on very significant volumes. HPCL, NMDC, RVNL are just a few examples here, down between 3 to 5%. Now, barring BEL and some of the other defense names, all other PSU stocks are trading lower as well. Now, look at NMDC. That 4 crore shares traded, 20-day average is 2 crore. RVNL's volume today is less than its 20-day average. And even HPCL's volume, which is among the top losers today, is not as significant in comparison to its 20-day average either. The last name on the list, Signature Global, one such name that's falling on heavy volumes. It's the 3rd straight day of losses, the top loser on the Nifty Realty Index, the biggest single day fall since November of 24. We have had 37 lakh shares that have been traded on the stock. The 20-day average is only 2.5 lakh shares. The stock has now moved below its key moving averages. It's down almost 30% from its 52-week high, which was close to 1,400 rupees. And despite that, it is still up around 2.5, 3x from its IPO price, which was around 385 rupees.
Thank you very much for that. There's one more stock, TCS, that's also slipping, that's hurting quite a bit, 2.5% lower on TCS ahead of numbers on Monday. Maybe the street expects a bit of a disappointment. Consensus expectations are that the company's top line will see a growth of about 0.3, 0.5%. But is the street expecting maybe a bit of a miss, a disappointment? The price action perhaps seems to signal that. Get into a break. On the other side, Vikas Khemani of Carnelian Asset Management will join in. Stay tuned. Well, the pressure is still on for the markets. Nifty down more than 200 points. It's holding on to 25,900. But it's breached the 20 and the 50-day moving average today. Sensex lower by 650 points. But Nigel, it's the Sensex weekly expiry. So what are the F&O trends that you are spotting?
Well, I'm tracking the Nifty actually today, and the Nifty, in fact, is trading below that 20-day MA, clearly telling you that it's a weak trading session in today's trade because there's not been even a 30-40 point recovery in today's trading session. And now the 20-day MA, which was a support, now that becomes a resistance. So on the way up, you'll have to cross the 20-day MA to feel good, which is the 120 points away from current levels from a bullish perspective. The one saving grace is the PCR. In a matter of 3 trading sessions, it's come down from around 1.5, which was closer to the upper end of the range. Now it's closer to the lower end of the range. That's because, the call writing has become a little bit too easy, actually. There's a little bit of complacency that's dipping in there. The 26,000 call, just take a look at the open interest built up. Massive, more than a crore shares out there. The premium out there is down to close to around 60, 70 rupees, I think. So 80 rupees, actually, the last time I checked. It was down close to around 60% from the top. The 26,100 call as well, premium out there, down close to around 68%. Last I checked, it was around 42 rupees. What this is telling you, when the premium crashes by around 60 to around 70%, the call writers are getting very, very confident, which in fact would give some glimmer of hope, though technically the structure is actually broken in today's trading session. The 25,900 put, on the put side, that's the most active. If you bought this particular put, getting into today's trading session, you would have bought it for ballpark around 15 to around 20 rupees. And currently that premium's around 71 rupees. So those put writers are making, put buyers are making a lot of money. Put buyers, beg your pardon. While the put writing now is gradually being observed out here because the bulls will want to defend the 25,800 odd mark. So that's going to be the important mark. The Nifty, as I said, it's broken down because it's trading below the 20-day MA. However, what's giving you some glimmer of hope, and which are going to be the key monitorables from here on, is going to be the Nifty Bank that needs to defend the 20-day MA. That's around 300 points away from current levels. You wanted to defend that mark. And big boy Reliance Industries from around 1,600 rupees, that as well has corrected. But the 20-day MA comes in at around 1,430 rupees. It needs to defend this particular mark. Individual stocks that we're looking at, IFL Finance, all through the week, it's been looking good. Today, there is some unwinding of positions that you're seeing on IFL Finance. Not fresh shorting, but unwinding. Hindalco, similar is the case out there. The stock is down, the open interest is down. So there is unwinding of positions out here. But one stock that's actually holding strong is IDFC First Bank. They pulled down their rates. The hope is that, in fact, momentum comes back into the stock from here on. And that's why you're seeing a bit of a short covering bounce that's playing out. Because though the Nifty Bank is down 200 points, IDFC Bank is up 2% with the open interest down. So keep an eye out on that name. Back to you.
Okay, all right, Nigel, thanks very much for that. So that's the F&O positioning as things stand right now. Vikas Khemani is now joining us. And Vikas, of course, is founder, Consolidating Asset Managers and Advisors. Vikas, good afternoon. First chat of the new year. So wishing you a happy 2026.
Prashant, wish you and your viewers a great 2026.
Well, I certainly hope that comes true, that wish comes true, Vikas. But today it's a bit of a down and out kind of a day, right? And it's one doesn't know. There are so many things up in the air. And somebody was telling me from a currency point of, from the person in the currency markets and rates market, etc., saying, well, from a macro directional standpoint, all this can't be great. It doesn't directly impact us. All that has happened since the beginning of this new year. It's another matter that here in India, we are affected in a special way because of these punitive tariffs of 25, another reciprocal of 25. And of course, what we heard last night. What's your sense, Vikas? And this is a directional view on the index to begin with. Do you think the market's preparing for a... It's all news related now in terms of the next big move, or the market will find its footing irrespective of news?
So I think, Prashant, every 3-4 years, if you see this kind of situation happens, it's not like, and I'll take your memory back to 2022. When 2021 we had a great year and 2022 began with a good note and Ukraine war started, and whole of the year, we only saw positive news coming through inflation, oil spiked up, inflation, and I think the sentiment was bad. Mid and small cap index had ended up negative about, I think, 8-10% or something like that. And Nifty was minorly positive for the whole year, right? And that 23 turned out to be a great year, right? If you say similar, 24 was a decent year. 25 was a kind of poor year from a small and mid cap perspective. Nifty was 3-4% up kind of stuff. So every few years there's a similar kind of setup which happens. And right now, of course, post Trump coming to the power, we have seen continuous negative news flow. And my sense is that, right now there's a lot of noise, rightfully, geopolitical situation the way it is, and that is clouding out investors' sort of market. As far as India is concerned, US, we all have debated to death that, the US tariff is not very significant as far as the Indian economy is concerned because it's not a very sizable part of India's exports. But having said that, you don't want that kind of situation. So even if that were to continue, Indian economy will chug along, and we have seen data in last 2 quarters of GDP and everything has turned out to be fine. So, and government has taken measures to kind of boost economic growth further. So it's not that India is solely dependent on US exports and hence, things will not work out. So India is chugging along well. But when India is doing well, even in a global, worrisome market, obviously, it is very natural to have this kind of sentiment and market. And we don't know how long it will take versus, and also how bad it can become as far as geopolitical concern. So hence, this is the kind of sentiment right now. Markets are, 500 points plus minus. We have seen in last couple of months in sense, in and around 26,000 Nifty has kind of hovered or consolidated. And once this kind of crowd settles down, I think there could be, resumption of the sort of direction upwards. I think there's a good fiscal deficit and fiscal stimulus has happened. Monetary stimulus has happened. GDP numbers are good. Demand is decent. So directionally, I don't see major valuations have corrected. Last year, India was one of the worst underperforming markets in the emerging market basket. Currencies at 90. So you have confluence of all the factors where say, look, downside seems to be limited. The kind of current environment might continue, uncertain might continue for some more time. But whenever this kind of happens, you might see. So I would like to believe that 2026 could be a better year than 2025.
So you're fully invested, Vikas, or because there is still some caution, many unknowns on the horizon, you are in a way hedging the bet on India, maybe increasing the allocation to gold or any safe haven, or diversifying your India exposure? I mean, or are you fully invested? And if yes, where are you incrementally deploying the money in India?
We are fully invested. I think, in fact, in last 1 month, whatever little money we were getting, we invested and all. Because our view has been that downside is kind of limited from a value perspective, and hence there's no point in waiting for the moment the noise gets clear, the things, whenever the uncertainty gets clear, you will see markets will not be here. So you can either choose timing or you can choose pricing. And wherever we are comfortable around the stock specific names in terms of, valuations, growth, comfort, we are kind of, buying and remaining invested. Wherever we are not, we kind of don't. So it's a very much stock specific call, and it's a very stock pickers market in that sense. So we are just continuing to pursue that in our portfolio building strategy.
All right. Hi, Vikas. Good to see you, Ben, and good to speak to you as always. So for 2026, do you think it'll be a reversal of 2025? In 2025, you saw the Nifty gaining a little bit, but the broader markets were under intense pressure. Portfolios got absolutely slammed, which is a normal phenomena that you see in equity markets, over a longer span of time. You have a couple of off years. Do you think in 2026, actually the broader markets make their way back and maybe, in fact, outperform the headline index?
I would say that there's a good probability of that. Learning from 2022 experience, where similar environment was there. 23 turned out to be completely, great for broader markets. So, like I said, Indian economy, there's nothing wrong. It's all progressing very well. And so it could be, I would assign a good probability of that, of kind of playing that out.
Okay, all right. That'll be the hope, because otherwise the headline index went up last year, but portfolios didn't feel like that. If you had to pick up a couple of themes, in the past you have mentioned that you've been more or less bullish on the manufacturing theme as well. Will you stick to that? If you were to give us 2 themes for 2026, which ones would they be?
From one thing, from a new theme perspective, new or not new, I don't know, but currently, given the geopolitical, the rearmament of the countries would happen, and hence there could be a lot of investment or reinvestment in the defense related globally, not only in India, and hence I do believe that that segment can do well, and any beneficiary of that, which could be metals, which could be many more players, could be beneficiary of that. So that's the one theme I do believe that can play out well, and this could be a longer term theme, because once the geopolitical situation becomes worse, I think every country wants to sort of become safe, invest into their spaces, yeah, in their safety. So I think that trend seems to be slightly long term, and it could play out not only in 26 but even way forward. So one needs to look at that whole space with a fresh pair of eyes. Other than that, I think you will see consumer discretionary player automobiles can, I think, this year, in my opinion, do well. Because again, growth is coming well, tax rates cut could benefit, interest rates cut could benefit, and so that could be a good segment to look at.
Defense, is that a new theme that you're liking? Because I remember in an old conversation, you were avoiding defense. So are you or are you playing defense via another way, this rearmament theme?
So that's what I'm saying, that we've seen some bit of valuation getting corrected there. Still, there are many of them are outside the comfort zone. But I did mention that we need to look at with a fresh pair of eyes that how should, in light of the current geopolitical situations, and I guess it will pan out like if, let's say, some further action happens on the Greenland, and few countries have mentioned that probably NATO is over. So if the NATO is over, then every country will have to reinvest in it. So I'm saying, I think one should keep a watch on this space. According to me, this will, this probably ship seems to be sailing, and there could be a lot of interesting stuff happening out there. So we are kind of, visiting, seeing this with a fresh pair of eyes on this. That how should one look at it?
Yeah. Because I think you put it well in that one line that you could wait for. The news of the price. That's how you put it, Vikas?
I said if you wait for the clarity, you will not get the same price, right? So and we don't know. So look again, you have to play probabilities. You have to play your comfort with the stock, individual business management. So we really don't take a big view on the market. Looks like market's going to consolidate here, but eventually you go down. Then don't wait too much of. If you get clarity, you will not get the price.
Yeah. It's just that it's become tougher, right, to try and assign probabilities because I think that is maybe
not easy part, right?
The number of the issue, which is that a range of possibilities also become much higher, larger. Well, Vikas, thank you very much for joining us. It's a great chat, and we'll leave it there for now.
Lovely chatting.
Okay, we'll take a quick commercial break here. As always, we come back, we get you what's happening with dealing rooms. Nimesh joins us on D Street Chatter. And buy today, sell tomorrow. Short-term trading ideas with the technical experts after that. Stay tuned.
Well, if you're hoping for a recovery in the last 30 minutes or so, doesn't seem to be the case, at least as of now. Adani Ports at the low point of the day, Jio Financial at the low point of the day, and Coal India as well has come in for some selling. So intraday charts of all these stocks actually should come up for you on the screen. The markets have taken actually a leg down and now trading well below that 25,900 mark. Good time to get a sense in terms of what's going on in D-Street chatter. Nimesh joins us to tell us exactly that. Nimesh?
Hi, Nigel. The last leg of the drag is largely coming in from the capital good names. So if you look at ABB, Siemens, BHL, all are under pressure on the back of that news flash that maybe the Chinese players will be allowed. So that's one space which has brought the overall markets down as well. But I guess the fall seems to be largely backed by very aggressive FI selling as well. That's been the consistent feedback for the last couple of days, that the FIs are better sellers. It's not showing up in the numbers, in the net numbers though, but there is selling is what I understand, and that's the case today as well. Across large caps, broader market names, there is selling pressure from large institutions. I think the Nifty has actually broken the crucial support of 25,920 as well. So need to see on a closing basis if we can sustain that levels. If that gets taken out, you might see further selling in the broader markets and in Nifty as well. Having said that, the PCR has now come to almost at 0.65 levels, and historically we've seen a market bounce back from those levels of 0.6, 0.65 levels. So that's a bit of a level to watch out for. It looks extremely oversold. And also understand from an HNI perspective or from traders' perspective, a lot of positions got squared off today after the big fall. So the market seems to be a bit light, and the PCR is suggesting the same. So watch out for a pullback. But at least the pressure seems to be largely coming in from aggressive selling from the larger FIs in the last couple of days.
Okay, got it, Nimesh. Tell us about individual stocks. What are you picking up?
Well, so the first stock on my list is Black Box. It's been under pressure today, but been largely range bound in the last couple of months. But I understand this quarterly update in terms of shareholding pattern can be quite interesting. Some leading domestic mutual funds have added, is what I understand, in Black Box in the last couple of months. So that's something to track there. That's the first stock. The second name is IEX. We saw a big up move after that court hearing. But in the last couple of days, one leading long-only FII and a domestic mutual fund has bought into IEX at current level. So maybe tomorrow is the day to watch out for the fine, if indeed it's a final hearing as far as the CRC order is concerned. So that's IEX in focus. The third name is Equitas Small Finance Bank. It's been under pressure of late, but I understand the selling pressure from a leading long-only FI is largely over. So watch out for further supply. Largely it's over is my sense in Equitas Small Finance Bank. And the last one is Zydus Life. Again, under pressure today and has actually underperformed the pharma basket of late. But again, the street is anticipating a corporate development. There is a strong chatter that maybe the company is looking for a very large acquisition. So that's something to track in Zydus Life.
Lots of acquisitions overseas, Nimesh?
Oh, looks like, Prashant, especially in the pharma names. Yesterday Sun Pharma was part of my chatter list. Even there, the anticipation is it's going to be a very large acquisition that the company might do. So Sun Pharma is one, and now Zydus is something which it has been anticipating a large acquisition. So watch out for this space very closely. Some big deals could be around the corner, especially M&A in pharma names.
And a couple of days ago, you mentioned a smaller pharma company. Any relation between these two? All of them are mutually exclusive.
No, so that's a small acquisition, Nigel. 2,000 crore market cap company. I know you're talking about Bliss GVS, but I think that's more like a domestic deal where a domestic player will buy out possibly that particular company. So again, it's in the works. I mean, all these M&As do take time. Sometimes, at the fag end, it falls off. So not to speculate too much, but yeah, there is a lot of pharma M&A is on the cards.
Got it. Okay. All right. Thanks a lot, Nimesh, for joining in and giving us all that buzz. Let's hop across to Mitesh now from Bonanza Portfolio, who joins us on the show. Mitesh, before we get your picks, earlier today, 25,920 was the important mark. Where does support come in for the Nifty? Because a couple of parameters, whether you look at the PCR as well and the way we have fallen just this week, there'll be some optimism of a bounce. But where does support come in at?
Nigel, I think this is the level which I was watching, 25,900 broadly to about 25,850, and we're right there. And there's no sign of a pullback as yet. So we'll keep watching it. But in case, we break below this, and there's certainly a chance because the Nifty has started slipping below a rising trend line on the half-day charts, so that's, I think, slightly worrisome. So one, I think we should recover and close about 25,950, 960. That should be positive. Otherwise, good chance that we are looking at a 25,730, 740 zone to be tested, and that further opens up downsides below that. So I think slightly negative in that sense. So I'm waiting in case we can recover in the last 15 minutes. It looks difficult, but yeah, because we are at the support area, we'll keep watching. I have two sell calls right now, or STBT calls right now. One is Tech Mahindra, which is a STBT with a stop at about 1591 for targets of around 1550, 1555. And the other one is Capital Goods. I think Nimesh was also mentioning that. BHL has had a very strong fall. So BHL is a STBT with a stop at 275.5 for targets of 265.
Okay, well, we'll take a quick commercial break here. And Mitesh, thank you very much for that. We'll see if these supports hold. Neeraj Dewan will be with us on the program in just a bit from now. There's 15 minutes to go for market closing.
Welcome back. Well, keep an eye out on the broader markets. A few stocks actually are calling for your attention. Transformers and rectifiers. They came out with a set of numbers. Actually, there was some growth that we saw. I think there was a switch in terms of management personnel, but that one has come in for a slam dunk, down 11.5% as we speak. Currently at the low point of the day, a big reaction is what we're seeing out there. You pull up a wider time horizon, of the stock chart as well. You'll see the stock has already corrected considerably from the top. So keep an eye out on this one. That numbers just came out close to around 30 minutes or so ago. Cupid, that's the other one, was trading down by close to around 4%. Now it's down close to 10%. So that's another accident that we're seeing. It appears there is some forced selling that we're seeing on this name as well. So keep an eye out on that. BHEL, the stock was down, I think, more than 11%. It's pulled back to a wee bit from the low point of the day. So just keep an eye out on this name. But the sector on the downside, which is losing its sheen today, is metals. Manisha joins us to tell us what's going on there. Manisha?
Well, yes, after making those constant highs that we've seen come in for many of those metals in last 3 and 4 months, and record highs and multi-year highs, it finally seems like there is a bit of a pause in that rally right now. The last 2 trading sessions actually have seen a decline for many of those precious and base metal prices to the tune of 3 to 8% in some of them as well. There are a couple of reasons for that. One, it is the strength in US dollar index. Second, it also has to do with some profit taking after that very strong run up that we have seen many of these commodities. And the third important one is the increase in margins in CME that has gone up quite considerable in the last 2 times in the matter of a fortnight as well. And the third point is about the rebalancing of indexes here, which is now looking at realigning, reweightages, fund allocations, and some profit taking because of that as well. So the Bloomberg Commodity Index annual rebalancing starts between January 9th to 15th, and this is the period you could be looking at volatility and some profit taking as well in many of those commodities therein. And there could be some declines that we could see in base metal prices like copper, aluminum. The net shorts have been increasing. There have been various statements from the banks as well. Citi, for one, says that the estimated outflow because of this rebalancing could be the tune of $6.8 billion just from the gold futures contracts. Societe Generale says that net selling in silver and gold could be to the tune of $5 billion each. And then you have TD Securities saying that 13% of the open interest in COMEX silver is going to get sold. Deutsche Bank says that index-linked selling could see a nearly 2.4 million ounces of gold in sense of outflows there. Goldman Sachs is also estimating that the selling could be to the tune of $5.5 billion in gold and $5 billion in case of silver as well. Interestingly, Saxo Bank says that index rebalancing sell-off is something that you could be looking at being bought into because the structural bullishness is still on. The fundamentals have not changed, whether it's about shortage, underinvestment in case of mines, the deficit that most of the metals are looking at, the geopolitical tensions, the tariffs, etc. All of that is still there, but there was a long due or profit taking that was anticipated in many of these metals, and that's exactly what we perhaps seem to be getting in right now. Interestingly, it also is about the US non-farm payroll data that comes in tomorrow.
Thanks a lot for that, Manisha. Well, we have Neeraj Diwan, independent market expert, who joins us on the show. Hi, Neeraj. Good to see you on the show. Thanks a lot for joining in. Well, some of these capital goods stocks, BHEL, they have come in for a slam dunk. Siemens, ABB, all of them have come down. And the fear is that Chinese imports could be back and they're going to be facing some kind of competition from there. Your view on these names?
Yeah, good afternoon. And thanks for having me on the show. So actually, if you see stocks like Siemens, ABB, the stocks have not been performing. They've been under pressure for quite some time. Short-term impact can be because of some phase of China import. But I think that is not the main thing. The main thing is earnings, because last couple of quarters also, we not see any major pickup in earnings. That's why the stocks have been drifting or staying on those in that particular range only. So I feel that this quarter is very important because third and fourth quarter for capital good, engineering, infrastructure are the most important quarters. So if third quarter you don't see any pickup happening, any material pickup as compared to last year, then they can be a problem for the sector. But I think let's wait for the results to take a view whether it's medium to long term, whether things are still in line or not. See, one space that still did well in this was, something like a Larsen & Toubro, which is also into capital good, engineering, infrastructure space. See, that showed some improvement last quarter in the results. So we saw that moment coming back in the stock. So I think what will be more important will be this quarter results to watch.
Okay, got it. All right, Neeraj. Neeraj, this is the market where you're seeing that prices are correcting, right, on various stocks. but some of them could be actually pretty good quality names. And maybe they're coming down to valuations that you like. So if I were to throw that open to you, the headline index is still just 1.5% away from the recent high that we saw. From either the Nifty, you have stocks like Trend that are down nearly half of what it was at its peak. Name a couple of stocks that you like.
As far as sectors are concerned, if I first look at financials is one space which have been doing very well, whether it's NBFCs, whether it's PSU Bank. They've given a decent return over the last few quarters, couple of quarters. And there's stocks there which are still reasonably priced. To look at ICICI Bank, it's a large cap stock which has started performing only in the last couple of days, and it's been languishing, even after a good set of results. A good balance sheet, good asset quality, decent names, and they've been able to maintain their names, which may improve now going further. So this is one stock which I feel in the large cap space deserves a look at, and it can be a good investment candidate. And among the others, L&T is another one which has been showing decent results, where you've seen some movement in the stock, but I think still there is good potential there. So L&T can be another from the large cap space. And in the large cap space, even if you look at sectors like infrastructure sector, capital goods sector, whether it's financials, autos, that is where you still see some decent movements happening. So you'll get good opportunities in capital goods where you've seen corrections. Like you mentioned, a couple of stocks which are down today also. I think there is value in those stocks. I think one can be accumulating those stocks for medium to long-term perspective.
This story, Neeraj, hi, afternoon, been a while, that government is planning to sort of, get Chinese firms to be able to compete for infrastructure projects, right? So there were restrictions on Chinese companies being able to bid for government contracts, Indian government contracts, and Reuters, they're sort of citing sources, but they're saying that the plan is to remove those restrictions. And I think the stocks are down because of this. You think it'll have an outsized impact, especially power? If you remember BHEL back in the day, Chinese imports for boilers, etc., was the bane of his existence. I'm talking about pre-2010.
One thing is that once the restrictions are removed, and let's see what sectors, where they're going to come and compete. So then we can take a call on specific, micro level at what kind of sector, like whether it's power or whether it's infrastructure, capital good. But right now the order books are good as far as Indian companies are concerned. It's basically still yet to be seen. But I think valuation-wise, we are sitting at a good level. Power, like you rightly said, has been under pressure for the last 1.5 years. Power stocks are not performed. Whether you take out the stocks like green power stocks, like something like integrated, like a Tata Power, they've all been down for the last 1.5 years. They've been under pressure. So if the demand is going to pick up, if the numbers are going to improve there, if the order inflow is good, I think there will be healthy competition. And it won't come overnight. It will not come tomorrow. Let's see. Let the things come first, and then we can take a call on specific stocks and specific subsectors.
Okay. All right. Got that very quickly, Neeraj, before we let you go. What about metals? All that glitters was copper, aluminium, silver, gold in the last few trading sessions. Last 45 days to be precise. More upside? Is this a temporary pause? Would you look to buy, or do you believe that they need to cool off more?
I think that some profit taking is happening, and that may happen for some more time, but I'm still positive. I think if there's some more profit taking in non-ferrous space, copper, aluminium, I think there is still upside. There's good potential. There's good demand. With industries opening in US also, the demand from US. So globally, I think that play will still continue. The space will remain strong. So I think if there's a decent correction, healthy correction, there are opportunities to again get into these stocks.
Yeah. Absolutely. I think there's about a minute to go for market closing. So let me just quickly wrap up things, right? And we're down about 270. We will end, of course, below the 20-day on the Nifty. So it's a kind of a clean break, and I dare say a convincing break as well. But it's also a market which is influenced in an outsized way by news, whiplashing things on both sides, right? So that's the other way to look at things. But anyway, I think you are down and down in a significant way today. So I'll just look at straight up some of the large losers that we had as far as the Nifty is concerned. Hindalco was down, the biggest one, 4% cut. Geo Finance was down 3.5%. Wipro was down 3%. ONGC, TCS down 3%. And very few names, not even one name with over 1% gains. Eternal was a top gainer with just about a 3.25% kind of a pop. Towards the end, I mean, the entire capital goods space came under a fair bit of selling pressure. BHEL, transformers and rectifiers, Hitachi, there was ABB, GE Vernova, and so on and so forth. So lots of pressure points right at the end coming through as well. Nigel.
Well, that's right. From the broader markets, there are a few stocks called for attention. Miso continues at lower circuits, so that stock was down another 5% in trade today. Transformers and rectifiers came out with a set of numbers. The stock got slammed, was down close to around 9%. Cupid lost its way. No much protection out there. That stock, in fact, was down close to around 8%. Hindalco, from the headline index was down, but Nalco did come in for profit, taking down 5.5%. In terms of positive news flow, you had Panisha Biotech, that was the lone ranger, up more than 10%. Positive news flow coming out there, while IDFC First Bank, trim rates out there. The street is hoping that the bank is back in terms of momentum. So that was the outperformer when you had the Nifty Bank down 300 points. IDFC First Bank actually stood tall, up close to around 2%. On that note, though, we'll wrap up with news that today was a weak trading session for the Indian markets, but the hope is that maybe in the near term, we could be a little bit oversold. Wrapping up on closing bell, stay tuned. Markets Forward comes up next.
on broad-based selling.
Metal stocks see heavy selling, making Nifty Metal Index the top sectoral loser today. The move followed a sharp overnight drop in the global commodity prices triggered by a one-time annual rebalancing of fund commodity allocation.
Export-oriented textile and shrimp stocks, including Avanti Feeds, Gokaldas Exports, end lower as President Donald Trump backs at a sanctions bill proposing 500% tariff on countries, including the ones that do business with Russia. The street feared it would impact India as well.
Hello and welcome to Markets Forward on CNBC-TV18, your go-to show where we aim to get you all the key data points to gear up for the next trading session. I'm Vinny Motiwala. With me is my colleague Mangalam Malu. Mangalam, today again a day we are seeing a bit more of a fall coming in. We couldn't hold on to 25,900, 0.8% of decline for the Nifty. Even the banking index, IT, most of the sectors today were trading in the red as well.
It was a tough day for the bulls today. It was a very tough day for the bulls today because not only did Nifty break important levels, after breaking those important levels, it fell like a hot knife through butter. And if you looked at the intraday chart of the Nifty, you would see that, at any point in time, if one went short on the index, they would make money by the end of trade. And as a result of which, it was a trending day which ended at the low point. Not just that, the broader markets, your portfolios would look like more red than green today. And the markets showed you that, 2,500 stocks in the red for about 400 stocks in the green, and even the ones which were in the green were just marginally so. Again, here too, once the intersection happened, the red and the green lines started to diverge and they ended at the widest point from each other. And that tells you that there was weakness right from the word go and continued towards the end as well. No respite, and which is what would hurt. When what started out as just fear that maybe, it could be because Donald Trump's sanctions would lead to bigger tariffs on the country, etc. The street is now fearing whether that happens or not, we don't know. But in the very near term, the hopes of a resolution or trade deal coming in get pushed back. And that's exactly what played out. And then towards the end, we had some, news that impacted a lot of the capital goods stocks as well. So just to sum it up in a line, it was a tough day for the bulls.
Absolutely a tough day for the bulls, but we have an exciting lineup for you all in store on the show today. First up, we'll talk about all these important movers and shakers in the day with Vivek from the Big Wall. Then we'll break down individual stocks, specifically metal stocks, why they came under pressure, the impact of Washington's Russian oil tariff bill on Indian exporters. What does that mean? As well as a major Maharashtra boost to Balaji Amines. That is an important one in terms of the expansion plans. Last but not the least, we'll delve into which are the key important events to watch out for in tomorrow's trading session. On that note, let's go across for our first segment. We have Vivek Iyer, who's at the Big Wall, to take us through those movers and shakers of the day. Over to you, Vivek.
Well, thank you so much for that. Well, Mangalam summed it up quite perfectly. A very tough day for the bulls, and that's what it was. Advanced decline ratio skewed in favor of the declines by a large margin. In terms of individual stocks, first on the list has to be Balaji Amines, one of the few names that actually stood out in the session today. Eligibility certificate coming in, some incentives, clearly the street like that. Select tire stocks did quite well in the session. Of course, cooled off quite significantly from the day's highs, but CEAT managed to end the day with some gains. And also a name like Niva Bupa, from the insurance space, that particular stock on good monthly data actually led to quite a bit of an outperformance, decent volumes there as well. But the list of losers quite long, and you did see sectoral pressure coming across most of the names. The first one, of course, has to be the capital goods stocks. The entire sector, all of the names especially in the last hour and a half. So significant selling pressure, reports indicate that there could be some Chinese competition that could be allowed to enter this particular space, and most of the names tumble anywhere between 5 to 12%. The entire IT pack, ahead of the result season, saw quite a bit of a profit booking emerge today. Names like T-Sales down almost 3%, Emphasis, Wipro, all the names, that had outperformed yesterday did see significant profit booking come about today. The metal pack, of course, one of the top laggards in the session, as a sector that's been outperforming quite significantly today, saw quite a bit of profit booking emerge here as well. Hindustan Zinc, the top laggard over there. PSU banks, again, very good operational updates coming for most of those names. But today you did see significant selling pressure on Indian Bank, that managed to actually go ahead and beat its own guidance, as she saw a 4% downtick today. And lastly, all of the OMCs, oil marketing companies, all of them too took quite a bit of a tumble. HPCL down over 5%.
Take that point, Vivek. Thanks a lot for that. It was the metal stocks that faced particularly heavy selling today. The Nifty Metal Index emerging as the top sectoral loser. This sell-off, we understand, comes off as global commodity prices slipped sharply overnight, prompting funds to adjust their commodity weightages as part of a one-time annual rebalancing exercise. Manisha Gupta joins in with the details of what transpired overnight in the underlying commodities and as a result of which, or the reason for which, all these stocks saw a big gash today. Manisha.
Well, yes, after making those constant highs that we've seen come in for many of those metals in last 3 and 4 months, and right now, the last 2 trading sessions actually have seen a decline for many of those precious and base metal prices to the tune of 3 to 8% and some of them as well. There are a couple of reasons for that. One, it is the strength in US dollar index. Second, it also has to do with some profit taking after that very, very strong run up that we have seen many of these commodities. And the third important one is the increase in margins in CME that has gone up quite considerable in the last 2 times in the matter of a fortnight as well. And the third point is about the rebalancing of indexes here, which is now looking at realigning, reweightages, fund allocations and some profit taking because of that as well. So the Bloomberg Commodity Index annual rebalancing starts between January 9th to 15th, and this is the period you could be looking at volatility and some profit taking as well in many of those commodities therein. And there could be some declines that we could see in base metal prices like copper, aluminum. The net shorts have been increasing. There have been various statements from the banks as well. Citi for one says that the estimated outflow because of this rebalancing could be the tune of $6.8 billion just from the gold futures contracts. Societe Generale says that net selling in silver and gold could be to the tune of $5 billion each. And then you have TD Securities saying that 13% of the open interest in COMEX silver is going to get sold. Deutsche Bank says that index-linked selling could see a nearly 2.4 million ounces of gold in sense of outflows there. Goldman Sachs is also estimating that the selling could be to the tune of $5.5 billion in gold and $5 billion in case of silver as well. Interestingly, Saxo Bank says that index rebalancing sell-off is something that you could be looking at being bought into because the structural bullishness is still on. The fundamentals have not changed, whether it's about shortage, underinvestment in case of mines, the deficit that most of the metals are looking at, the geopolitical tensions, the tariffs, etc. All of that is still there, but there was a long due or profit taking that was anticipated in many of these metals, and that's exactly what we perhaps seem to be getting in right now. Interestingly, it also is about the US non-farm payroll data that comes in tomorrow. So ahead of that, there is some more choppiness that you can expect.
Thanks so much for that, Manisha. But let's take the discussion forward now. And we are joined by our experts for today. We have market expert Neeraj Diwan as well as Richard Jain of Motilal Oswal Financial Services joining us right now. Neeraj as well as Richard, thank you so much for joining in. Neeraj, your thoughts first in terms of the capital goods space today as well as the metals pack. We did hear Manisha right now talking about obviously the rebalancing factor that comes in, and which is why we're seeing a bit of a fall today coming in for the metals pack. But even capital goods today, on the basis of some sources and news flows coming in, we're seeing a sharp fall there. Your thoughts on both these sectors?
Yeah, good afternoon. First, to talk about the capital goods space. If you see capital growth, power-related space, which anyway has been under pressure for the last 1 year or so, or maybe a little more. The stocks have anyway been consolidating because of the earnings not picking up. Last 3-4 quarters, earnings have not picked up as far as capital goods is concerned. And this news that has come today, I think it's too early to react on that news. Because let's see what kind of competition are we talking about, what subsector, whether it's power, engineering, infrastructure. We need to first have a look at what subsectors can impact it and what sort of competition can come their way. So let's not be in a hurry to react on that. I think the stocks which have been consolidating because of poor earnings or poor earning growth, what is important to see is whether third quarter earnings are better or not for them. Because third quarter and fourth quarter are normally the most important. So let's wait and see third quarter numbers and then see how this news can impact. So what will be important to see would be the earnings performance of this quarter and then take a call from there. And
all right.
Second, yeah.
You go ahead. You were speaking.
Yeah, second, you were saying about the metals, the kind of correction we've seen in metals, whether it's aluminum, copper, zinc, silver. I think the kind of demand supply which is there right now the kind of metal strength which is there globally, I think will stay. But there'll be bouts of correction because recently in the last 2-3 weeks we've seen a good move. Whether it's copper, aluminum, stocks have really gone up a lot. Metals prices have gone up a lot. So after this kind of exuberance, some correction will definitely happen. Some profit taking will definitely happen. But I think this is a healthy correction. If this happens, then you get some more correction. I think there'll be buying opportunities coming one way because I think still there is a lot of strength when you talk about medium to long term as far as non-ferrous metals are concerned.
Right. Ruchit, just hang in there. We'll come back to you just to close the loop on the reasons why the markets fell, and then obviously we'll ask you about the levels, etc., that one should look at. But one of the bigger reasons also for a lot of these export-oriented textile and shrimp companies, etc., including the likes of Gokaldas Exports, Avanti Feeds, all of them on account of a sanctions bill, the possibility of a sanctions bill which proposes a 500% tariff on countries that continue doing business with Russia, which includes the likes of India and China. Hormaz joins in with more details. Hormaz.
There's pressure clearly on all of these names, be it the textile names or the shrimp feed exporters. And to tell you more is, of course, most of these companies, as we have been reporting all through these last 9 months, is the fact that they get almost 50 to 70% of their revenues from the US market. So be it Gokaldas, be it Avanti Feeds, or be it the likes of other names like KPR Mills or even Apex Frozen, all of them seeing losses of anywhere between 5 to 9% in today's session. Gokaldas at one point was down even 12%, and it has almost now more than halved from its 52-week high levels. Of course, today's big news was the approval given by Donald Trump to the Russia sanctions bill, and that bill allows him the power to impose tariffs of up to 500% on companies that are still buying Russian oil or dealing with Russia. That is subjective, of course, country by country basis. Of course, you need to be aware of the fact that this bill has just been given approval by Donald Trump. It needs to be approved by the Congress. It needs to be passed in both the houses, and then it could transform into law. So that is something that needs to be accounted for. Of course, there is certainly fear on the street with regards to this, but the one thing that needs to be noted is that barring Gokaldas, most of the shares that fell, they fell on insignificant volumes. They were not significantly higher in comparison to either their 10-day or their 20-day average. So that needs to be taken into account as well. And the third quarter results will be the other important factor to watch out for, especially considering the fact that this will be the first full quarter of the 50% tariffs that took effect towards late August. So that impact will be seen on these companies. So it will be interesting to see the commentary that you get from these companies at the end of the quarter, and of course on the road ahead on this bill as well.
All right, take that point, Hormaz. Thanks a lot for that. Let's get back to Ruchit then. Ruchit, it was a knife through hot butter. That's what the market was towards the end of trade, at least. What are the levels? I mean, what should one look at? Because now, intuitively, one thinks that the earlier resistance of 25,700, 25,750 would act as support now that we're slightly over it and we've broken below important support zones too. Would you concur?
Yes, hi, very good afternoon. Well, since the first week of October, in this entire journey where we have traded with either sideways bias or positive bias, the 50-day MA has acted as a good support on every decline, and the 50-day MA was around 25,900 now, and we have ended slightly below that. So I think the follow-up move would be very important tomorrow. Although looking at the market bed which was there today, it seems that we could see a breakdown of this 50-day MA, and of course a follow-up move tomorrow as well. So and tomorrow being a weekly close, it would be very important to see. And if we get a weekly close below the 25,900, I think that would confirm start of a corrective phase after this entire up move. So on the corrections, 25,700, as you rightly mentioned, which were the previous resistance levels, that would be the first support levels to watch out for. And if that is not held, then I think 25,500, 25,400 would get opened up. So I think tomorrow's Friday close would be very important to watch. Today's market action certainly is not good, considering that 25,900 has been breached on the closing basis as well.
Okay, tomorrow's close is going to be key to watch out for in terms of levels. Surely we'll be keeping an eye out on that. But on that note, let's move on to the next stock, which was some bit of a bright spot in today's trading session, and that is the shares of the chemical manufacturer Balaji Amines that surged over 10% today in the trading session. And the firm has actually received an eligibility certificate from the Maharashtra government for its unit expansion under the mega project scheme. Let's go across to Sonal to get more details on this one. Sonal, over to you.
Well, yes, Balaji Amines is bucking the trend. The stock is up around 12%. It is on the back of a subsidy that the company has received. It's a certification for one of their units, which is under the mega projects by Maharashtra government. And that is where they have been made eligible for a subsidy of 258 crore rupees. Now, that's a big number. Additionally, it will also be exempt from payment of stamp duty for a period of 7 years, starting 2024 till 2030. But of course, it is basis the point that around 50%, it is to the extent of 50% of the state GST taxes payable on sale of products by Balaji Amines. Now, this is something which was expected by the management. In their Q2 con call, they did indicate that there is an expectation of a subsidy for their subsidiary, Balaji Specialty Chemicals, where they are undertaking a capex of 750 crore rupees. So, if they are getting 1/3 of it as a subsidy, that's a big number. The expansion is something which is around a lot of products. It will come up for you on the screen: EDTA, sodium cyanide, EDTA 2Na, hydrogen cyanide. So these are some products they will be manufacturing under this subsidiary, out of which Unit 1 of the EDT products will be commissioned next year this year in September, and the next one will be in December. They expect improvement in operating performance once all these projects come on stream. That is not it actually. They do have a DME plant at Unit 4, which is to be commissioned in FY26 itself. There's another expansion that they are planning in FY27. So all of them, if they come together, this will improve operating performance. Plus, they've also gotten a subsidy approval. So this is positive. Anyway, most of their projects were to be funded by internal accrual. So this is just additional mounting coming through for their balance sheet. So that is a positive. There is fundamental news in Balaji Amines, but even Alkyl Amines, which is the direct peer, is surging in trade on the back of this move that we've seen for Balaji Amines.
So, thanks a lot for that. Neeraj, what's your thought on the chemical space? A lot of people increasingly getting bullish on it.
Yeah, again, you'll have to put two parts to that. One is which have a lot of export, and one is which is, less of export and more of domestic. So I think Balaji Mines will form the category where the export is quite less, I think 15%. So I think these kind of stocks are better placed, which are agrochemical, pharmaceutical, domestic consumption. So I think there one can take a view or medium to long term. Also, I think some positive momentum should continue and should come because the stocks have corrected a lot in the last couple of years. So there is definitely opportunity there. As far as stocks which have more exposure to exports, 30, 40%, 50%, I think there one can still be a little more cautious because we don't know what is going to happen as far as trade is concerned. There's still a lot of, it's not clear at all. So stay with stocks which have more of domestic consumption.
Right. Thanks so much for that point there, Neeraj. But Neeraj as well as Richard, thank you so much for joining us this evening on the show, as always. But on that note, we're going to slip into a very short break. After the break, we'll get you the top corporate voices, which are the important events to watch out for in tomorrow's trading session as well.
This is markets forward, a tough day for the bulls, but a lot of corporate action that took place today as well. And we got to a few of them on our channel. United Breweries, that's the one that joined us today. And they've launched a new beer, Kingfisher Smooth. So that's a brand extension that they've done in their main brand. They said that they expect the beer category to grow between 5 to 6% in 2026 after a sub 5% growth, a poor 2025. They said the premium segment, which grew over 20% last year in 2025, that is, will continue to drive growth, while Kingfisher Smooth, their new offering, which is now in one state, will be rolled out nationwide in the next 12 months and will be their biggest bet yet.
The next management that we had on the channel today, IRB Infra's management, they said that the toll collections in the third quarter has positively surprised the company. It expects the toll operators transfer 17 road segments to add around 750 crore rupees in toll revenues. With this, IRB said that its asset base is moving closer to 95,000 crore rupees mark and is on track to scale up to 1.3 lakh crore over time.
And business services provider CMS Info Systems expecting the deal with SEBI, or rather SBI, to add about 500 crore rupees in the next 10 years in incremental top line, with a 30 to 40% revenue upside over the next couple of years on that itself. Their services business will continue to compound at 12% over the next few years.
And before we wrap up this edition of Markets Forward, let's go across to Upasna to tell us which are the important events to watch out for in tomorrow's trading session. Over to you, Upasna.
Well, first up, let us look at the global economic cues in US. Unemployment rate for the month of December and even non-farm payrolls data will be out. India, foreign exchange reserves, bank loan and deposit growth data is something we'll be closely watching out for. Now, coming to corporate action, IEX will be in focus as the market coupling order case is scheduled for tomorrow, the next hearing. And in terms of results, important results for tomorrow, we'll be tracking IRDA and Tejas Networks as well. Now, on the IPO front, Bharat Coking Coal, which is a wholly owned subsidiary of Coal India, opens for subscription tomorrow. Now, let us look at some of the key other important events. Now, Trump and oil executives to meet to talk about Venezuela. We'll be keeping a track of that as well. And AMFI media conference call is scheduled for tomorrow to discuss mutual fund industry's monthly data for the month of December 2025. And lastly, India and Europe crucial FTA talks, they end tomorrow in Brussels. So we'll be keeping a track of that as well and any key important update that comes out from this meet. So all in all, looks like quite a power-packed day tomorrow.
A power-packed day tomorrow indeed, Upasna. Thank you so much for that. It's Friday tomorrow too. With that, we'll wrap up on this edition of Markets Forward. Stay tuned. More news and updates on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty fall for the fourth session as new tariff concerns loom over the Lal Street. Over 8 lakh crore rupees worth of market capitalization wiped out in a single session. JP Morgan's Jahangir Aziz urges corporate India to invest more domestically. Tells CNBC-TV18 the corporate investment has remained stagnant for the last 12 years. Says there is a need to dive into the structural problems stopping corporate India from expanding capacity and investing in India. Republican Senator Lindsey Graham says the U.S. President Donald Trump has backed a legislation that threatens to impose 500% tariffs on countries buying Russian oil. The senator's statement highlights the bill would give Trump tremendous leverage against countries like China, India and Brazil. New Delhi is yet to respond to the statement. The U.S. seizes a Russia-flagged Venezuela-linked oil tanker in the Atlantic Ocean after a week-long pursuit. United Kingdom provides enabling support. American officials claim the previously sanctioned vessel is part of a shadow fleet. Moscow slams the seizure as a violation of maritime law. Trump directs the United States to withdraw from 60 international organizations, including the United Nations Climate Treaty and the India-France-helmed International Solar Alliance. The White House says the organizations targeted for withdrawal no longer align with American interests. Federal agents shoot and kill a 37-year-old woman during an immigration crackdown in the U.S. in Minnesota. The U.S. government claims the person was a domestic terrorist, cites self-defense, but says the woman's death was preventable. Weeks after a clash with Adani-run Navi Mumbai Airport, the authority over network connectivity, telecom companies spar with Noida International Airport. Companies claim the airport management deployed their own network and has sought cumulative fees of over 32 crores a year for operators to use the infrastructure. Telco slammed the fee as arbitrary and exorbitant. After an agonizing wait of over 4 years, Mumbai gears up for civic body polls. Voting is scheduled for the 15th of January. The reunion of the Thackeray cousins and friendly fights overshadow civic issues. All of that and more coming up for you, but let's start with the day's market action. A sea of red across the board today, with the markets failing to hold on to the 25,900 mark, specifically for the Nifty. BSE listed companies have erased market cap of more than 8 lakh crore rupees today. In fact, take a look at that. 264 down on the Nifty, the Sensex losing almost 800 points, 300 gone on the Nifty Bank, and the Midcap index down over 1,200 points today. In fact, the Nifty closed in the red, and there was sectoral indices erasing gains across the board, with metal and IT stocks amongst the biggest losers this afternoon. Prashant joins us now to wrap up the day's market action. Prashant, clearly nervousness being witnessed there on the Lal Street. What is weighing on the market?
Well, today we finally broke what we've been talking about as levels which are important in the near term. The 20-day went away and on the Nifty. And I think for the Nifty Bank, we've sort of come pretty close to those levels as well. So that's typically seen as a bit of a short-term direction changer. We'll see if that is the case this time around. But all through this week, and maybe towards the end of last week as well, the market's been coming slowly but steadily lower. I mean, actually on the Nifty Bank, the mid and small cap indices, corrections were between 0.5% to 1% through and through. I'll just sort of, it was a down kind of a day. If you look at advanced decline, for example, some 4 declines for every one stock which was higher. So that kind of sort of told you the intensity of the fall. The large cap losers, metals, have had a pretty strong, one of the very few sectors which have had a good 25 and good start to 26 today. Of course, pulling back, Hindalco was down about 4% today. And JSW Steel was down about 3% or so. Tata Steel was down about 2% as well. So metals as a pack sold off. Other Nifty losers, Wipro down 3%, Geo Finance down about 3.5%, and a name like ONGC gave up about 3% or so in today's session. Just about 4 or 5 names of the Nifty ended in the green, and not one with gains over 1%. So I'll sort of I won't mention these names.
All right, many thanks for joining us. That's Prashant there with the market action. Now, corporate India needs to start investing in the country. That's the word coming in from Jahangir Aziz, head of emerging markets of the Economic Research Division at JP Morgan. Speaking to CNBC-TV18, Aziz said that India Inc. needs to think about expanding its capacity within the country, adding that corporate investment has remained stagnant for 12 years. The question, though, is why? And it is no longer a cyclical issue, as is very evident. There are structural issues at play. Take a look.
You have to get corporate India to actually start investing in the country. If corporate India refuses to do that, then you can get episodic ups and downs depending on what the government does, but that's it. The question that needs to be seriously asked, and we need to stop thinking this as a cyclical problem. After 12 years, I think you need to ask ourselves, what are the structural problems that are stopping corporate India from actually expanding capacity and investing in India?
Well, that is Jahangir Aziz raising an important question. Why is corporate investment stuck for the past 12 years, and what can perhaps be done to try and unleash that? On to the energy markets, where oil prices rose after 2 days of declines. This is an unexpected fall in U.S. crude inventories, provided impetus for investors to buy futures while they monitor developments in Venezuela. Now, U.S. crude stocks dropped by about 3.8 million barrels compared with analyst expectations of a 450,000 barrel rise. Gold prices, meanwhile, have softened as a stronger dollar made bullion more expensive for holders of other currencies. However, geopolitical tensions have limited losses, with the ongoing US-Venezuela conflict continuing to feed safe haven demand. Silver prices also extended losses today, falling below the $76 mark. Republican Senator Lindsey Graham says the U.S. President Donald Trump has greenlit a legislation that threatens to impose 500% tariffs on countries that buy Russian oil. Graham said in a statement that the Senate could vote on the bill as early as next week. The Republican lawmaker said the bill would give Trump tremendous leverage against countries like China, India and Brazil. New Delhi is yet to respond to the development. The bipartisan legislation is designed to grant Trump sweeping authority to economically isolate Russia and penalize major global economies that continue to trade with Moscow. Graham and Senate Republican leaders have been working with the White House for months to try and reach an agreement on a final version of the legislation. A White House official said that Trump supports the legislation, so this is the worry that is playing out even as far as the markets are concerned. But staying with the big global story, the U.S. has seized a Russian-flagged oil tanker with links to Venezuela in the North Atlantic region. In a social media post, the U.S. Army confirmed that it has in fact seized the tanker named Bella 1 for violating sanctions. The UK has also confirmed that they provided military help to the US to conduct this operation. Reports said the Trump administration had been pursuing this tanker for the last 1 month. It tried to evade the US blockade around Venezuela. Russia strongly condemned the seizure, asserting that Washington had no legal right to use force against the vessel. The Interior Minister of Venezuela has said that at least 100 people died when U.S. forces attacked the capital city to capture President Maduro during a pre-dawn raid last Saturday. The Venezuelan army had earlier posted that 23 soldiers had died in that attack. Meanwhile, Venezuela's interim president, Delcy Rodriguez, has said she's open to an oil deal with the Trump administration. This comes days after President Trump called for full access to Venezuelan oil fields. U.S. Secretary of State Marco Rubio has said the U.S. will take 30 to 50 million barrels from Venezuela and sell it at global market rates. Energy Secretary Chris Wright has also said the U.S. will ensure that revenue from the oil sale will be used for productive reasons, whatever those may be. Take a look.
Step one is the stabilization of the country. We don't want it descending into chaos. Part of that stabilization, and the reason why we understand and believe that we have the strongest leverage possible, is our quarantine. As you've seen today, 2 more ships were seized. We are in the midst right now and in fact about to execute on a deal to take all the oil. They have oil that is stuck in Venezuela. They can't move it because of our quarantine and because it's sanctioned. We are going to take between 30 and 50 million barrels of oil. We're going to sell it in the marketplace at market rates, not at the discounts Venezuela was getting. That money will then be handled in such a way that we will control how it is dispersed in a way that benefits the Venezuelan people, not corruption, not the regime.
We're not taking their oil. We're not taking their oil. We have put a blockade on and prevented them from selling their oil. That's choked off cash flow.